Welcome everyone to the second Cambridge Fintech and Regulatory Innovation regional live session. This is a combination of Asia Pacific and Sub-Saharan Africa. And we're really looking at module 2 here, deconstructing banking. What I will do is give a brief introduction first of all to the module. Then I have great pleasure in introducing you to our guest speaker for this week, who has lots of rich experience in both continents, amongst other areas. And then we'll have, as we did last week, an interactive session. So please don't be shy about putting questions, comments in the chat box, and we'll do our very best to collate those and hopefully answer them as well. All right, so we'll just give it another few seconds to get a few more people to join. So just make yourselves comfortable there, and we shall begin. And welcome to all those who are joining. I should also say that this session, although it's focusing on Asia Pacific and Africa, everyone is welcome from wherever you come in the world. So we don't want to exclude anyone. Everyone is welcome. The focus, though, is very much on challenges in those two regions. Right, okay, I think we will get going with everyone's permission. So I'm Nick Drury. I'm working for the Cambridge Centre. I'm a research affiliate at the Cambridge Centre. Also, I work for Cambridge Cares in Singapore, where we're doing work on all sorts of scientific research, in particular decarbonisation and world avatar projects. And my background is very much financial services, both on the incumbent banking side, as well as also more recently, of course, in fintech. So welcome again to this module 2, this regional session, which is on deconstructing banking. And in this module, what we'll be doing is having a look at the activities that banks have traditionally engaged in and how these are being deconstructed, disrupted and deconstructed by new actors and new business models. So in simple terms, banks make and receive payments. They borrow, they lend, they offer risk management services and provide information to customers. That's the traditional model. But over the course of this model, we're going to be considering how various new innovations are changing the way that these activities are being provided. So by the end of this module, you'll be able to explain the areas in which fintech is having the most disruptive impact and understand and discuss some of the key drivers that are unbundling banking. And these are, for example, digital transformation, platform-based fintech business models, and open banking. You'll also be able to identify the potentially problematic areas associated with innovation in digital banking products in terms of the regulatory and policy implications, and then assess the opportunity for the use of innovation offices and public consultations in your own specific jurisdictions and contexts. So that really is a summary of what you should be able to do at the end, or by the end, I should say, of this module. Okay, I'll move very swiftly on to introducing our very special guest speaker this week, someone well known to me and indeed known to a lot of the financial services community and ecosystem globally, Mr. Ariel Wolanov. He's the managing director of FinServe Experts and the firm's lead solutions architect. Ariel is globally recognized, and he's globally recognized for a number of things, amongst others, thought leadership. And he's led a lot of the teams that have delivered emerging technology solutions for M-Pesa, for example, HSBC, and Lloyd's of London, amongst many others. Ariel advises central banks and regulators and finance ministries around the world. He also advises the UK Parliament on blockchain and artificial intelligence, and has addressed the G20 on how emerging technology can enable financial inclusion. So Ariel, with great pleasure, the floor is yours.
Great, Nick, and thanks for that flattering introduction. I don't think I stand a chance of living up to the way you've painted me, but I will do my best. It's great to meet you all, and I really appreciate the opportunity to have this chance to speak with you. Next slide, Amelia. I won't spend too much time on this as Nick has already introduced me, but I have worked on a number of emerging technology projects in the fintech space and advised regulators on how to cope with that. Go ahead and flip again, Amelia. The green countries are the countries where I and my team have worked and delivered projects. I have lived in Africa, lived in Kenya for 2 years. I've lived in Singapore, worked in Indonesia, Thailand, South Africa, Nigeria, Ghana, elsewhere. So I do have some familiarity, though I would view with skepticism anybody who said they were an expert who was not a native to the region. I at least have some knowledge of the marketplaces that you guys come from. Next slide. So really what Nick and Dee asked me to talk about was really 2 things. One is to talk about the areas where fintech firms are having the most disruptive effect and impact on banking, why that is, and the impact that that has on regulators and the sort of changes that regulators are going to need to make to to address those disruptions and make sure that their job of looking after people's welfare and safety is being well done in this field of massive change. Go ahead and we'll go ahead and we'll dig in. Next slide, Amelia, please. And probably the biggest one by volume, quite frankly, is that major banks are abandoning the mass market retail segment. They are being driven out of the market by fintechs with whom they can no longer compete. People have been writing about this for at least 10 years, but it's actually happening now. So Citibank last year announced that they are exiting retail banking in 13 countries, including India, China, Singapore, and so forth. HSBC is withdrawing from retail banking. Barclays is closing branches left and right. So this mass exodus from the banks who have historically dominated the retail segment is underway now. And they aren't just closing branches, they are intentionally driving people out by not serving them well. So it's not just a question of divestment. They are creating waves of dissatisfaction with how they are serving their customers, and they're doing it intentionally. So this is not happening. So why is this? Next slide. There's really several things going on that are causing fintechs to drive major banks out of the retail space. Probably the biggest one, in my opinion, is that in the modern era, branch networks are actually a liability. They don't help. A few years back, I was working for Banorte, which is the largest domestic bank in Mexico, and we were trying to convince them that that they needed to change. And one of the ways we did that was to build a focus group of new affluent entrants. So these are young professionals who had graduated from university within the past 2 years. And we asked them a number of questions, but probably the most interesting one was, what do you want from your branch? And the answer that we got, and this was from several hundred participants in the focus group, was almost unanimous. What we want from a branch is to never have to go to it. Okay, so the new retail banking customers do not want branches. They want to do everything they need to do without ever having to go into a branch. I remember doing some work with OCBC, which is a large bank in Singapore, and they were very proud of themselves for making the branch comfortable for the people standing in the queue. They had TVs showing popular programs, they had a coffee machine, they had comfortable places to lean against, but they weren't thinking about, why is this queue there at all? If you really want to make happy customers, don't make the queuing experience more comfortable. Get rid of it. Fintechs who are now able to address these banking needs don't have to carry the cost of a branch. So they are, by definition, going to be more cost competitive while still giving customers the service they need. The second area is that legacy infrastructure costs are not competitive. Banks are paying huge amounts of money for their core banking solutions that fintechs don't have to pay. We're going to get into that in detail when we look at the next factor. And the third reason is that regulators, having gone through a number of financial crises and uncovered cases of gross negligence and malfeasance, are increasingly putting regulatory demand on banks to exercise a duty of care for their customers. Not all fintechs who are engaged in those same lending activities have that regulatory demand. And even when they do, they have simpler operating models that make it much easier for them to meet those regulatory demands. So these are some of the reasons that we're seeing this disruption and why fintechs are already, even today, driving large banks out of the retail banking segment. Next slide. The second thing that's happening in parallel with that is that core banking systems are no longer as relevant, and they are a huge cost reduction for many banks. Now, I was working in Africa for 2 or 3 years in the middle of the 2010s, and many of the banks there had ideas that were, quite frankly, more innovative, more advanced, and more customer-centric than the ideas I saw coming out of mature economies like the US or the UK. The problem, despite having superior ideas, is that they couldn't execute on them because they were held back by how long it took to make changes to their core banking systems. So a new financial product or a new customer service innovation that could be rolled out in as few as 4 to 6 weeks was taking 1.5 years because they were hamstrung by their core banking platforms. Replacing these platforms, in many cases, runs the cost of doing it, even for a small or mid-sized bank, can run in the tens of millions of dollars. So it was, quite frankly, the situation where to replace Temenos or FlexCube would cost more than the bank actually had as assets on the books. It was a complete non-starter. What we're seeing now is cloud-based solutions to do core banking as a service. And that is fundamentally changing time to market for new entrants, time to market for fintechs and for banks that embrace banking as a service platforms instead. Now, these are not cheap, but they are a fraction of the cost of trying to upgrade an existing core banking solution. But more importantly, it allows banks to go to market with new solutions much faster. And that is a second piece of why the large banks are being driven out, because a bank that is running on a platform like this has a huge advantage. Now, this also has huge impacts for regulators. Number one, it means that regulators have to cope with the fact that the pace at which new financial innovations, new financial products, new service models, new ways of engaging with customers are unleashed. So they are now, banks that embrace this and fintechs that embrace core banking as a service can now bring new financial products to market much faster, new ways of serving their customers to market much faster. This creates pressure on regulators who have to be much more responsive than they had to be even 2 or 3 years ago, because they are now have to keep up with an accelerated pace of change. Next page. Okay, so the reasons this is happening, cost is a big one. rapidly evolving compliance, but most importantly, time to market. So people are adopting these solutions, even though the license fees of these core banking platforms are quite expensive, because it allows them to bring the new financial products to market much, much faster. So that's really what's driving this. Third factor, Amelia. Next slide, Amelia. The third thing, the big disruption that's happening is how credit is evaluated. And I was personally involved with this. There is a lending capability called M-Shwari in Kenya, which sits on top of the M-Pesa platform and allows users of M-Pesa to apply for credit in a completely automated way via their USSD mobile phones. This lending capability was introduced in M-Pesa actually quite early in M-Pesa's story, as early as 2010. But for the first 4 years or so, nobody was actually taking advantage of this capability. Peak loan originations per day had maxed out at about 500. And for a max value $200 microloan in a country of over 40 million people, 500 microloans per day is noise. Simple reason was nobody could qualify for those loans. Half of Kenya is unbanked, but even the ones who are banked don't have the kind of digital financial history that could drive an Experian, a FICO, and Equifax. So when I arrived in Nairobi in 2014, Isaac Owunde, the chair and CEO of Commercial Bank of Africa, asked me, quite frankly, could you use machine learning, look at somebody's spending patterns on M-Pesa, and decide whether or not they are creditworthy? I instantly answered yes, even without thinking about the problem, partially because I'm an econometrician by training. And I figured with that rich kind of data, we ought to be able to do something. More probably just because I'm a natural optimist at heart. But no amount of optimism prepared me for the result we got. So we built this machine learning capability for them. We deployed it in the market, and we were astounded by the results. The number of loans that CBA could originate, peak per day, had gone from, in a year and a half, had gone from 500 to 50,000. So basically, we have made an entirely new group of individuals and SMEs eligible for credit who had never been able to access credit before. The thing that really shocked us was that in doing that, we actually improved the bank's non-performing loan ratio by 26%. So not only did we qualify a bunch of people for credit, I was pretty confident we were going to do that, but we actually significantly outperformed FICO in predicting who was going to default. That was an astounding result. And we're not the only ones doing it. One of my current clients, Finexos, is doing that here in the UK now. There are other people who are looking at these other ways of evaluating credit. And this is going to completely change who can qualify for credit and how they can qualify. Students, new entrants to the labor market, people who had trouble, and people for whom FICO is just not an accurate predictor. Next slide, Amelia. The performance of traditional credit models is getting worse over time. The models and the assumptions on which they were based, which were perfectly valid assumptions in the 1960s, just aren't true anymore. As a result, banks and fintechs are missing out on huge opportunities in key segments. People who are thoroughly, capable of servicing a loan. So in Kenya, we had a persona of somebody who ran a car mechanics garage, had been in business for 30 years. Grew the business, had about 12 employees, and didn't have any debt. This person was perfectly capable of servicing a reasonable sized loan to grow his business, but because all of his business was in cash, he didn't have the financial footprint to qualify for a loan. The moment you look at his spending patterns over the same period of time, you can qualify that person for a loan. Which we did, and they had no problem paying it off. And we've seen the results. So in the 5 years since this capability was announced, the GDP per capita of Kenya has almost doubled, largely driven through SME job growth. So this is, these kind of results are no joke, and they make a huge difference. And as a result, this particular disruption becomes a huge vector for financial inclusion, which in turn creates both an opportunity and pressure on the regulator. First is to provide a regulatory framework by which these you can get these alternative methods into the marketplace as quickly as possible, but also making sure that you are exercising that duty of care, and that you're doing that in a safe, responsible, and most importantly, in a transparent way, so that regulators can go on doing the job, their very necessary job of looking after people. So moving forward, please. Amelia, next slide. So thinking about, again, regulatory response in this environment, thinking about these factors, what are we talking about in the duty of care? Financial products are coming to market much more quickly. So regulators need to operationalize and get as efficiently as possible the ability to respond to the myriad new financial products that are being released, and be able to put a stop to the unsuitable ones as quickly as possible. The recent flagrant abuse of buy now, pay later being an excellent example of this. They need to find a way for fintechs, who are small companies who are taking advantage of this huge opportunity caused by the exit of the retail banks, and find a way that a small fintech not sitting on a lot of money can accurately assess the affordability of a prospective borrower to afford a loan. Now that the technology is there, and the capability is there to do this well, even for a small and not very well capitalized fintech. But there needs to be regulatory support and a framework by which these smaller fintechs can take advantage of that capability and properly assess affordability. The third thing, and this is not new, this is about, this is as old as financial lending. The regulator needs to be on the lookout for bad actors who are perfectly willing to charge extortionate rates to borrowers. And this becomes harder with all of these new financial products coming out because a lot of them are structures in a way that vary this extortionate cost. So it requires a lot of horizon scanning and a lot of testing and putting together a framework that doesn't slow the pace of innovation, but clearly identifies when somebody is behaving in a way that is financially irresponsible and ends up hurting the very people that that these financial innovations are supposed to help. Next slide, please. With specific regards to the explosion of crypto assets, obviously this creates huge challenges in putting together proper KYC AML. Now, in the Bitcoin space, actually people, Bitcoin exchanges have made huge progress from even 3 years ago in effectively capturing, KYC and AML data. But the problem is that as despite the fact that actually some of the exchanges have done a pretty good job, the innovation is still growing faster than people's ability to adapt. How do you handle KYC and AML in a DeFi situation where there isn't a central organization to make the investment or to police the infrastructure around KYC and AML? It's a challenge. How do you ensure that as people come up with new ways to make money, that they are still respecting their taxation duties? And critically, how do you provide a regulatory framework for transparency? We've recently had the crash of Terra Luna. Even a cursory look at the tokenomics behind Terra Luna, by a non-expert, would have identified their strategy as lunacy compared to their claim that Luna was a stablecoin. But they were able to effectively hide that. How can we come up with a way that that enforces the necessary level of transparency without stifling innovation. It's a tough balance. Next slide, please. Payments, none of these are new challenges. This is something that regulators are already focused on: privacy, data security, cross-border regulation. But again, the pace of change is putting pressure on coming up with regulatory frameworks that keep pace with that. We're seeing a lot of progress here, but these will continue to be areas of focus. And it's really about design. So it's not about the framework itself, but it's designing a governance process that sits above the framework so that the evolution of the framework itself is business as usual, can cope with the rate of change while keeping the innovation in a particular country, in a particular market, competitive. Because what happens, if one market decides it wants to do a better job of regulation, but their improved regulation slows innovation down, what you get is capital flight to a market that doesn't impose that. That's obviously not good for anyone. So coming up, designing the governance models for regulatory frameworks that allows them to evolve rapidly is absolutely key to any particular country maintaining a competitive edge in the financial services it offers to people who are willing to invest, and more importantly, to the people who live in that country. Next one. And finally, this is a newer area, but it's one that I'm convinced is going to be increased importance, which is embedded banking services. So this is when you are shopping online and you sign up for a buy now, pay later plan, or you sign up for an extended service plan, you are entering into a financial, you are buying a financial product at that point. It may not look like it. And the problem is that, people who are operating, who are not regulated financial entities, international traders, e-commerce, manufacturers, service providers, sometimes with no ill intent, are actually offering financial products that should be regulated. They don't know it, and it's not their fault. They're not intentionally trying to to skirt regulations. They are just unaware that by offering somebody the ability to pay for something 30 days after they buy it, they've now sold that person a loan. So this is fairly new, but this is now a question of regulators, again, having the horizon scanning capability to able to pick up what that unregulated financial activity is in place, but equally to provide, again, what a regulator doesn't usually want to do is stifle innovation in its country, is to provide an easy transition plan. So you've got an e-commerce site that has started offering a buy now, pay later plan to its customers. Say, that's great. We want you to do this. Here's a 5-step process. It'll take you 2 months to execute to bring your activities under a regulatory umbrella with a level of transparency, but also something that doesn't cause that company, which might be very well run, to go out of business. So these are, go ahead and go to the last slide. These are my initial thoughts when Nick and Dee presented to me what I thought the trends were around the deconstruction of banking and how regulators needed to respond. I hope that was useful, and I'm now happy to talk about, take questions.
Thank you very much indeed, Ariel. That was very, very insightful, particularly you talking about some of your experiences in the regions. And I also like the way that you started off with something quite provocative there, perhaps suggesting that, incumbents are creating, in your words, quote, waves of dissatisfaction, unquote, with customers. And in fact, we've had some very interesting questions as well in the chat box here. And if I may, I'll just start off with the first one, which from ND Lovewood is asking, with these disruptions from fintech, will banks survive another decade in your view? Are we seeing the end of banking?
No, absolutely, these banks will survive. Their strategies are to, well, actually, most of them will survive. Some of them will fail. but their strategies are to focus on higher value customers. Now, I think that's pretty myopic. So I was talking to the head of data science at a group level for Citibank, for instance, and they were talking about, yeah, we're just going to shift our focus to people of high net worth. That sounds great. They're going to be competing with the likes of UBS and Credit Suisse, who've done this for centuries, let alone decades. And for them to be thinking that it's just a walk in the park, we're going to roll out some new financial products and life's going to be good. It won't be. I think they are completely myopic about the level of challenge they face. But these are organizations that are hugely funded, and they will survive their education process as they try to manage their strategy. The other thing is that there are things that the banks do that I think that this wave of fintech challengers in the retail space are still decades away from having the infrastructure or the relationships to pull off. Trade finance being an excellent example. A fintech challenger is not going to be able to originate a global letter of credit. They are not going to be able to provide cross-border merchant services anytime in the near future. So there are a lot of places where banks still have an enormous advantage and where nobody is going to be able to touch them. But will banks be serving the mass market retail segment a decade from now? No, not at all.
So, to carry on those thoughts there, Ariel, Harris Dindy is asking, from your past experience, on average, how long does it take for a bank or a financial institution to change from a legacy core system to a digital capable core system? Any thoughts about that?
Yes, lots. This is a good part of what we do for a living, day and night. So I can give you very detailed views. The answer is it depends on how you do it. If you try to do what consultants tend to call a digital transformation, the answer is years, if in fact never. And if I could leave you with one piece of advice for those of you who are thinking about it, is do not transform, migrate. It is absolutely a waste of money and a huge headache you will never get over to try and transform from one core banking platform to banking as a service, or from one banking as a service to another. That is a huge piece of work, and you will never get your ROI from it. What I would advise say is basically roll out new products, address new customer segments, and start them on a banking as a service platform. And don't try to move an account on one product from one platform to another. It is it's a money sink, and you will never get your payback for it. Instead, as you roll out new products in the loan space, in the deposit space, in the savings space, merchant services, start those new products on your platform. Consolidate them only at the highest level for your reporting purposes, and never try to transform an existing product from one another. Just migrate to a bunch of new products, over whatever pace of business change is otherwise suitable for your bank or your fintech, and leave off ever trying to transform them. Slowly sunset your dependency on that core banking, and by the time you've completely transformed your product set, then voila, you will have been able to decommission your core banking platform.
Okay, I mean, Aga has also made an interesting point here. Like a number of us probably on this call, he's spent a couple of years in Zurich working with two of the larger banks there, particularly on their legacy support. And he's asking, at what point do these really large global banks make the leap into the cloud and abandon the systems? Is it going to create an even bigger opportunity, for example, for the challengers and the digital banks?
I think it's a great question. Will some of the large banks that have completed those transformations, shed themselves of their branches, gotten out of having a legacy estate, then be able to start moving back down the value chain? Yes, definitely, but I think that's 5 to 10 years away. It is even 5 years ago, it would have been impossible to do that. Many countries still have very restrictive data residency requirements that make it hard for a global enterprise like UBS or Credit Suisse to move to a cloud. Several things are changing that landscape as we speak. One is that regulators, again, are starting to get more aware of that and to overcome some of the more protectionist-minded political forces in their various countries. To give an example, the Clause 19 of the Trans-Pacific Partnership, which didn't end up going anywhere, I think perhaps because the U.S. pulled out of it, but there was a clause in there that said, if you sign up to TPP, you accept the data, your customer's data can be resident in any other member TPP country. So that was, it was a revolutionary change. And unfortunately, TPP didn't get the level of adoption that, that a lot of us hoped it would. But, that was already 4 years ago. So people were already thinking that way. I'm thinking that some of these transnational agreements will start to provide a framework by which regulators can accept a more cloud-based solution and still fall within the mandate of what their country demands of them. But the other thing, quite frankly, is that we're the presence of a reputable cloud infrastructure in more and more countries is growing. So the other one way is to solve it is through regulation, and that's happening. The other way is to put the capacity on the ground. So if you are a bank and you're operating in 10 countries, and all of 10 those countries now have a level 3 or a level 4 data center and all the cloud infrastructure, then it becomes possible to say, we don't need to change any of the regulation. We now have in country the cloud infrastructure we need to support this and still be compliant with our regulations. So I think the convergence of regulatory easing around data residency plus an increase in in-country cloud capacity will get us there.
Okay, very good. We'll come back to data because that's so central to everything. I'll try and combine a couple of these questions from Adam and again, another one from Aga here, which relate to the balance, I think. This is from the regulator's perspective now, how one can really drive that balance of not stifling innovation, whilst at the same time making sure that customers are safe, we don't get leakage of funds and data and everything else. So as regulators, how are they supposed to balance all this? It looks on the face of it like there's an awful lot of moving parts here. We've got the revenue generating parts, we've got the operations, we've got the analytics, we've got many different functions in the banking side. We've got all of this, cloud-based developments taking place on top of legacy systems. How are the regulators supposed to tread in this sort of ever-changing, moving environment? Any thoughts there?
Again, tons, because we do this for a living, but there isn't a one-size-fits-all answer because every market is different. The needs are different. But I think one thing that I think is overarchingly true is I see too much focus on the regulation itself and not enough on the governance around the regulation. So if you have a regulation that is stifling innovation, it's less of a problem if you have the governance to say, we can update our regulatory framework on a quarterly or even a monthly basis. What you have then is a tolerance to react pressures and quite frankly, a tolerance for mistakes. The countries, and this is a critical point. The countries where, like Estonia is a good example, Singapore is a pretty good example, even the UK. The countries that do well are countries that have a regulation culture that is mistake tolerant, because the countries, particularly some of the more autocratic countries, the problem is that the loss of face around admitting a mistake is so huge that even when everybody knows it, it's a mistake or that this regulation needs to change, it's politically untenable, even if the need is common knowledge. If you have a regulatory governance framework that says we are going to update our regulatory framework every quarter or indeed every month, then you could put things into that roadmap and say, okay, we're going to address the need for cross-border payments. We're going to address the need for digital assets. We're going to address the need for embedded financial services. We say, yes, It's in the roadmap. And if something doesn't work, you put it back in the roadmap. You say, oh, this isn't working. This is allowing too much predatory behavior. This is stifling innovation too much. If you've got a roadmap that you measure in months and quarters, you have the agility to update it. So focus less on the regulation itself and more on the governance framework. If you have a governance framework that allows you to evolve rapidly, the problems will take care of themselves, because regulators by whole are actually reasonably smart people. They can see the horizon as good as a businessman can. They just need the ability to act.
Yeah, and I think that that's an interesting point. I mean, so are we talking about, when we're talking about regulatory governance, you're talking about regulatory governance, you're talking about the mechanisms within that governance as well as the system itself. So for example, it could be whether it's an entity-based approach or it's a risk-based approach, or are you also referring here to, let's say innovation offices or regulatory sandboxes as mechanisms to control, or perhaps not control, but filter innovation in a safe way? Are you referring to part of that or something else?
Sandboxes are great. The countries that have implemented sandbox programs tend to do very well out of them. But sandboxes are not the only one. The best thing that sandboxes do is they help regulators learn. They give regulators the ability to understand where innovators are going in a way that mitigates the risk of that new activity to the country's citizens or businesses. They are one great way for regulators to learn and to experiment with regulations that will work. They are far from the only way. Excuse me. So I would say that the focus needs to be on enabling regulatory agility, the ability for regulators to update their regulatory frameworks as a matter of business, so that the businesses and individuals in a country expect the regulations going to it's next, it's the third week next month. We know that there's going to be an update, and they, so people put it into their plans. Sandboxes are a great learning mechanism. There are others. You can have focus groups, consultations. You can do some sort of embedding, regulator and exchange programs. I've seen a lot of different interesting ideas.
Yes.
But the focus should be on how do we enable the learning process and how do we enable the agility.
Okay, very good. I mean, I'm asking this question as well, Ariel, not least because I think it's of interest to our audience, but also because we have a question specifically here, which is how do you regulate something that hasn't been fully developed yet? For example, crypto-backed lending and the whole crypto space, which is very much under the radar screen, where you are in the UK as well as other jurisdictions.
So I think how do you regulate it? I think in the first instance, you need to learn about it. So, and this is going to